Hello, good people. Emmanuel in Safari bring you the Promise Insurance Show. Today, I'm still featuring Old Mutual, UAP Old Mutual products, the life insurance products. There is this package, but let me start with this small video because we are featuring what the company offers. Right. So that is a good preamble now that you're featuring UAP Old Mutual. But let's also look at this interesting concept that came in from there's an article I read, and it mentioned that life is no longer just for death. It's about getting paid to live well. Well, this is a best South African company, Discovery Life, which talks about an article that was issued recently in the year 2025, May 19th, where they're talking about in a world where people live longer, Discovery Life is defining life cover by paying out more to clients while they are still alive. So, not that I'm featuring this product, but actually the truth of the matter is this particular product actually also looks at almost the same kind of concept. So we're talking about, okay, this is particularly theirs, but what I wanted to highlight is contrary to industry norms. Okay, this is more or less still the same. Life insurance clients usually receive payouts while they are still alive, not only when they pass away. This flips the life insurance script with people living longer. Life insurance isn't just only about protecting one's legacy, it's also about ensuring the client's risk profile consider both longevity and for a well-lived life. So, again, I want to talk you to the key facts document, and this is also a recent development as of the year 2025, which demands insurers to come up with a 2 or 3 page document that summarizes all the benefits that you get out of these policies. So, whereas the other one was considering so much children's education, but you could also have your own dream, your own goal you have, and you want to set aside funds. And you're also saying that I'm actually going to secure that kind of future dream, whether I'm there or not. So let's look at what it entails before we go into the example. So, Sure Deal Investment Plan Key Fact Documents, that's a KFD. So again, of course, you're talking about you have to read through all these and you actually have to sign them. But let's look at the features. Sure Deal Investment Plan Value Statement. This is a guaranteed investment plan which enables one to accumulate a sum of money over a specified period. At the end of the accumulation period, the insured gets the accumulated savings and accrued interest as a lump sum payment immediately on the maturity of the policy. So this is a little bit different from the Somesa that we featured earlier, because the other one doesn't pay out in lump sum. This one pays you in lump sum. So what are the key unique features? Subject to the policy being in force. Being in force means it has to be current. And then the Sure Deal Savings Plan provides a guaranteed lump sum to the policy owner at policy maturity. How the plan works. A, the accumulation phase. This is the period in which the payments made towards the plan are accumulated and credited with guaranteed interest. Premium will be paid monthly, quarterly, semi-annually during this phase, or a lump sum, a single premium at the beginning of the plan. The sum insured is the amount payable to you in return for the premium payment. You may choose a target amount and the premium payable will be calculated. Yeah, so that's very key to note. Though, of course, I'm going to use an example, which is I use more or less the same target with the Sure Deal or the Somesa that I had done earlier, so that we can compare and contrast the premium. What's that? The factor. What will change? What will be the difference? Phase out period. Yeah, these are necessary things. This is the period in which the sum insured being accumulated and the guaranteed interest are paid as a lump sum upon maturity of the policy. Okay, that is a little bit straightforward. Benefits payable on death, life cover. In case of death of the policy owner or the person responsible for the premium payments during the term of the policy, the following benefits are extended to the beneficiary. An amount equivalent to 10% of the sum insured will be paid immediately to the family or named beneficiary or guardian of the policyholder. So meaning this is like Mabugo, this is paid within a short time. And then the expected sum insured 100% to be paid at the end of the policy term. Please note that the policy should be fully paid at the time of death and is in an active state. So this policy means that if you had set out a 10-year period and God forbid death happens in the first year, you're going to actually wait up to the end of the 10 years to pay out to meet your particular goal that you had set out for. Yeah, but of course your premiums would stop. Okay, let's look at the other benefits. So 3, we're talking about benefits, optional benefits, but secured at an additional cost. Okay, disability and death of the policyholder. In the event of the death and permanent disability of the policyholder, all future premiums for the remaining saving period are waived, and an amount equivalent to 5% of the sum insured will be paid immediately to the policyholder at that said time for disability. Okay, so we are saying we shall stop you from paying your premiums. Yeah, that is a waiver because the insurance company will actually pay on your behalf. And then on top of that, if it's disability, we can pay out 5% of the sum insured. We shall look at those examples as we go by. But if you have a target of say 10 million, okay, 10 million not possible right now. The minimum is about 30 million. That would be about 15 million shillings. No, 1.5 million shillings. Yes, is what we would pay out to help you. At the said disability, it's like some mini kind of insurance on your disability to help you get moving with your policy. Then also waiver of premium. This is benefit where premiums are waived off for the remaining term of the policy term following the unfortunate death or disability of the policy owner. So if you do get permanently disabled or you die midway, of course the policy would tell you, would automatically mean that there is no more paying of the premiums. But your policy will actually mature upon maturity. Then, of course, here you have to fill out the time frames and the general conditions. So possibly let's go at this point in time, just look at the example. I've used myself the way I usually do. Someone born of 85, this is someone in their 40s. If I choose the disability benefit, the accidental benefit, let me start with the option of monthly. And then the period is minimum of 5 to 10 years. Let me choose 10, just like because I used the other time, 10 years. So let's look at a target of say 30 million, which is more or less the minimum. Okay, and if I'm to start this, yeah, it has already calculated for me. So it's showing me that I'll be contributing 207,000 on a monthly basis. And let's just look at how much that would inculcate. Okay, so this is 207,047. So times 12 times 10 years. So meaning I would have put in a minimum of 24.8 million at the end of the 10 years. Meaning I'll have a return of about 5.1 million. Yeah. Should I save up throughout the period of the time? So if you compare with what we had done with Somesa, you realize this one attracts actually less premiums because the risks are not as high as those of the Somesa, which had the child income benefit. Ekyo kankiddemu oba okugeragezanya policy neya Somesa Plus gye twafeaturinga mu kusooka, ojja kulaba nga premium weno abeera mutono nnyo nga musigaza value y'emu kubanga yo erina risks ntonoko okusinziira ku oli ey'abazadde abaagala okusecuringira emisomo gy'abaana future. Katugambe, let's say we're taking an annual option. Of course, in our Gamba, I told you that whenever you are doing annual or you're doing quarterly or semi-annually, there are discounts. So you realize instead of someone paying monthly was about 24 million, here you're going to see someone is going to be contributing about about 23 million. So that means the 30 million minus if it's annually, it is 2.35, meaning upon maturity you would have accumulated 23 million. 23.53866. Let's put a 0. Yeah. So such that you get a net return of about 6.4. So that return, because the money is actually being used to invest. So that is the difference, but you will realize that the return is a little bit higher compared to the person who goes for the short Somesa. Of course, these other things are just to get more information about the client. There is also KFD. This is the document I was talking about. That if you have agreed to a minimum, of course, depending on the items you want or the value, let's take a scenario of if I have used the minimum premium or target of 30 million. Let me look at the minimum, which requires something that requires what we call a medical checkup. Because this is something above the free cover limit. So this is 2 billion though. So let me just reduce it. Okay, let's see what it's saying. Oh, this is 120. Let me say 200 million. 200 million would get you a premium on a monthly basis of about 1.2. Yeah, if you're looking at a target of 200 million. So again, let's look at the figures. Those numbers don't lie. Let's look at the figures. Okay. Let's just look at the figures here. 1.21928 times 12, then times 10. So this person would have accumulated up to 146 million. Yeah, but at the end of the day, they're getting a return of about 53 million. So this is something that makes much more sense for the people who have some good disposable income. And let's just look at the implication if you're paying annually. If you're paying annually, that means you would have accumulated about, instead of the 14.6, because there are discounts, you would have accumulated much less compared to the figure you would have accumulated. So that means you would have contributed about 138 million at the end of the 10 years, minus that, 0. So you're looking at about a return of 61.3 million. So you compare that with the person who was saving monthly for the same target. Here you're getting something more than 6 million, considering to the 53 million someone would have gotten if they are paying monthly in terms of premiums. But of course, you have the options of quarterly and all that. So I don't want to go into all that much. Let me just wind up with this key facts document, because it's the necessary step. It gives you a highlight. Remember, all the benefits we are talked about are based on the sum insured. So for that, someone having a target of 200 million, for the Mavugo would pay 10% of the 200 million, which is 20 million. But of course, someone having 30 million will pay just up to 1.5 million. This is just Mavugo. But then we're supposed to pay the full 30 million at the end of the policy term. So these are the things that you need to look out for. The minimum period is 5 or 10 years. All the things you have to calculate for you. And then, because now we're using new systems that are really virtual, It's only this key facts document that someone has to print out for you, or you can print out yourself, and then you put the terms as per the quotation that we would have agreed upon, depending on your age frame, your age, and then how long you want to serve. And then you acknowledge, we send you the policy document to your email. You can print it out. We can print it out if you want, no problem. But you have up to 30 days to claim that, you know what, you're not happy with the contents that were agreed upon, so that we can refund your premium. So we have a 30-day payback period. So you should should you not like the contract, but after 30 days, the policy will be in force. And you also have to meet your obligations. That's why you're seeing everywhere. Okay, here they're talking about the sum insured being above 130 million are required to undergo medicals. A simple medical checkup at a recommended medical facility free of charge. Actually, this became about 200 million. It used to be 130, but right now we're saying even those who have less than, more than 130 to 200 million, we shall consider you as a free cover. Beyond that, of course, this will change. But this came because we realized many other people had prefer those options where they really don't have to go for those medicals. But if you want and you can afford and you want a higher target, of course, we shall meet that cost, by the way, at the hospitals of our choice. They can be in the hospital in Kampala. They usually use the hospitals in Kampala. But if you're outside of Kampala, we can also recommend some of the hospitals in your town, wherever you are. Whether it's Arua, whether it is Jinja, whether it is Mbale, name it. Okay. Major exclusions, of course, suicide, we have mentioned. And then there is, of course, if you're in people related to war, criminal acts, hazardous occupations, dangerous sports, and abuse of drugs and alcohol. This is, you can easily, you're at the mercy or the discretion of the company. So, of course, it's important to disclose all material facts of the policy, since it's the basis of for the insurer's acceptance and appropriate premium costing. Then there's a waiting period of 6 months. This will be applied to death or disability claims within the first 6 months of the cover resulting from natural illnesses or causes. Death and disabilities resulting from accidents will be considered. So if it's an accident, you have to pay by other benefits. But if it's natural causes, there's a 6 months waiting period. Then there's a policy reinstatement. If the policy lapses for non-payment of premium, it may be instated at any time within 12 months after date of lapse, upon written application to the company with the production of any required evidence of insurability satisfactory to the company, together with payments of all overdue premiums and repayment or reinstatement of any loan, both with interest to the date of reinstatement at a rate of interest determined by the company, compounded annually. Yeah, so lapsing means that if you have set yourself for a monthly contribution, you have actually up to 3 months to inform us should there be anything you fail for one reason or another. We know the economy sometimes changes, salaries don't come on time. So those kind of issues, if they happen, you inform us. And we have a system that helps collect those premiums. So it's always good to communicate. Okay. Policy lapse, we talked about failure to pay for the 3 consecutive months or more will put your policy in a lapse state. The policy automatically gets cancelled, subject to applicable terms and conditions. A policy can be activated by payment of the premium arrears and interest thereof. The premium payment, we talked about premiums that are to be paid to secure the obligation of the company to pay the benefits guaranteed under this policy. Ensure that you sign a standing order form to collect the insurance premium to prevent the policy from falling dormant or lapse. Please note, the bank reserves the right to charge a fee for the standing order or a penalty if your account is not funded. Okay, that's also another disclaimer. The bank usually determines how much they will charge you should you not honor your obligations. So it's also imperative, if you sign the direct debit form with the bank that you have chosen, you can always inform us so that we can inform us 2 days in advance before that day you have put, so that we don't actually put your application, your debit payment in there, so that you actually get a penalty. And you usually know when your salaries have not yet come through. But always actually opt for the options of people who are doing quarterly or annually or half yearly, rather than the monthly bit. But of course, for the salaried people, you have that option as well. Surrendering the policy. Okay, there's the paid up value. If the policy owner, because of uncertain foreseen reasons, might fail to continue with premium payment as per policy provision, and provided that the policy has at least 3 years worth of regular premium paid, the policy shall be made paid up. So this is also through communication. If you have managed to save up for minimum of 3 years, but for whatever reasons, you say that, put my policy on hold, I've gotten a challenge, I've lost a job, or I've traveled out of the country, I'm not able to remit the premiums on time, you can put the policy on hold, but not for more than 1 year, 12 months. After that, you should be able to reinstate it. But surrendering is also another option, where someone says, yes, I've gotten those same circumstances as the paid up, but I am actually not interested in the policy any longer. But at least you must have acquired a minimum of 3 years. Same thing just like here. So, of course, the policy has to be in active state and has at least 3 years worth of premium paid. The policy should qualify for a surrender value, which shall be determined as follows: 95% of the sum benefits of the savings benefits premium, then the gross premiums, or the gross premiums are paid net of the rider premiums, and note that there is a reduction of the guaranteed death benefit premiums at 5% of the maturity benefits or savings premium. So this is a little bit technical. I don't want to go into that calculation, but it is still over and above what you have accumulated. And it's the return that is at the discretion of the company, because if you have your target was set 10 years and you have only done 5 years, now usually these companies break even. That's why they lock you for at least 3 years, because the break even point is above after 3 years. So beyond that, now it's at that point in time that the company can share whatever return has gotten, depending on the bonuses and declared. Much as this is the policy that has a guaranteed return, and this is one of the few companies that has that kind of arrangement. Others do not have that. All right, let's just conclude with this. The maturity claims period claim procedures, that is a little bit simple. Of course, upon maturity, just come with your policy document, and wherever you kept your documents or with your loved ones, let them send through either the email copy or the hard copy if you had printed it out. Okay, and then of course national ID or passport for the foreigners, and then the standing order cancellation forms to ensure that the halting of the periodic premiums, or deductions. On death claims, that's on maturity. Now on death claims, of course, here we shall need the beneficiary or the next of kin shall notify us, and subject to the original policy document, claim form request, national ID or death certificate, and then a police abstract or the letter where death is caused by an accident will be required. Permanent disability is more or less the same. Get medical reports from the hospitals and all that. Surrender claims, in case of a surrender claim, we shall also require the original policy document and the ID document. Of course, in the declaration, you say, I have reviewed the key facts document and understand the key details, benefits, terms, and conditions of the policy. The details have been clearly explained to me by my agent in a language I understand. I acknowledge that I have had an opportunity to ask questions and seek clarifications or any aspect of the policy, and I've understood the key details or benefits, terms, and conditions of the policy. So you sign, and then the agent also signs, and then we are good to go. So, ladies and gentlemen, I want to emphasize once again as I conclude, what are the key takeaways? You can actually set out and say life cover is no longer just for death. It's also about getting paid to live well. So you will actually need money. The cost of living is actually increasing on a daily basis, every other year. I mentioned an example that when I was in senior one in the year 2000, I paid about 300,000 shillings as school fees. For the same school, 20 years down the road, it's the school fees is now 3 million plus other requirements. So that's an inflation of more than 1,000%. So it shows that things are really skyrocketing every other time. But look at a situation where you're saving. As I mentioned this as an example, someone saves, let's say, 1.3, that's 13.8 million a year, and they would have accumulated about 138 million. But upon maturity, they will have, actually, should anything happen, we're going to pay 200 million to their family members at the end of the 10 years. But should nothing really happen, they're going to come and claim 200 million. That means they would have gotten a return of about 61.3 million. So really, it's no rocket science. Let's embrace these kind of policies as I conclude. I mean, Emmanuel Science Safari, bringing you the Promise Insurance Show, but let's just